Over the past few years, financial markets have risen to extremely high levels, but strangely, it's come at a time where there's more economic risks than ever before. The AI bubble faltering, China invading Taiwan, tariffs rising, interest rates staying elevated on the back of persistent inflation, and that's just to name a few. So in this video, I want to talk through the 7 most likely factors that could hit your retirement savings and how to best protect yourself from an impending economic downturn. Now, the first risk I want to talk about is the risk that the AI boom stalls. And there is a massive execution risk around this. There seems to be a $100 billion deal after $100 billion deal, with everyone raising money to invest in data centers or increase capacity or more computing power. But with pricing and valuation so high already, there is a massive risk that this goes wrong. And the bigger risk is probably whether they can execute what they actually need and what they've announced, or even more importantly, how long that takes. This is a massive increase in capital expenditure. Similarly, will energy be affordable enough to power all these new assets that are being built? And what if the demand for AI and the execution of AI doesn't come as quickly as expected? We're not saying the AI boom's going to disappear overnight, but it may take longer to come to fruition than many people expect. Why does this matter? IVV, for instance, so the iShares S&P 500 ETF, has 8% in NVIDIA, the maker of semiconductor chips, 7% in Microsoft, 7% in Apple, 4% in Amazon, 3% in Broadcom, 4% in Google, and approximately 35% just in IT and 10% just in consumer-facing companies. Similarly, VGS, or the Vanguard International Shares Index ETF, has 28% in technology and 10% in consumer companies. NVIDIA, now $6 trillion company. Apple, $6 trillion company. Microsoft, $6 trillion company. 17 companies in the world now have a market cap over $1 trillion in Australian dollars. And 11 of those 17 companies are in some way part of the AI boom. So lots of portfolios are inadvertently exposing themselves a lot to this boom. So the questions you have to ask and think about when you're planning for retirement, where resilience is what really matters, is do you know how exposed you are to these individual companies? And are you diversified enough if something goes wrong? The second risk I want to talk about is the risk that government policy, particularly in Australia, hits residential property. There are always saying that is something unexpected that ultimately hits markets and creates the next correction or the next crash. Now, with such a strong majority, the ALP, or the Australian Labor Party, is playing with tax reform. They've raised all kinds of ideas. They've executed Division 296. And among the biggest issues on the agenda, that remains on the agenda importantly, is property affordability. Every few years, negative gearing is raised as an issue. Obviously, no changes have been made this year, but there's always a risk that some slight changes get made. What if government policy changes, whether through boosting supply of property or limiting the tax benefit or profitability, or the tax benefit you get from negative gearing on property as well? This would obviously be bad for property investors, but much of our index in Australia, similarly to the US, is reliant on lending secured by property. So what happens to profits and your dividends if lending starts to slow? We've seen some of this in the last few years from some of the second tier, or the big 4 banks, but the slower growing Westpac and ANZ, for instance. So IOZ, the iShares S&P ASX index, and VAS, the Vanguard Australian Shares ETF, and VHY, they hold about 33% in financials, and VHY holds 40% in financials. Pretty much all of that is in the major banks. 10% in CBA, 5% in Westpac, 5% in NAB, 3.5% in ANZ. That's a lot of money in a single sector that is very focused on lending money secured by residential property. The next risk I want to talk about, and this is growing and it's covered increasingly in the paper, is that there's a risk that illiquid assets get shut or frozen. That is, asset classes like private credit have been incredibly popular. This is non-bank or shadow lending, as it has been known. Yeah, less leverage than investing in a bank, but these are ultimately shorter-term loans funded by investors putting money into individual funds. So while there's popular, there seem to be a never-ending number of new providers entering the market, and this asset class can be a good and a high-quality asset class as long as you do the appropriate due diligence and understand what you're investing into. And the key here is that not all credit is the same. Nor does every manager have the experience required to do what they need to do, particularly if things get difficult, if the economy starts slowing, if businesses start struggling. So credit in this sector benefits from active management, the ability to knock down the door, the ability to review contracts, the ability to protect yourself or your investors as you're investing into this sector or lending money to companies. But most importantly, what matters is transparency. When everyone runs to the door, and we know they always do at some point, whether it's a good investment or not, people generally get caught up in this negative sentiment and concern about protecting their money, and they want their money back. These funds, not just in private credit, but in all these other private asset classes, real estate, infrastructure, a lot of asset classes could get frozen. Where these funds offer liquidity in the short term, as in the ability to redeem your money quite quickly, but are investing in long-term loans, which isn't necessarily the case for all private credit, but most private credit is actually more short-term. There's a liability mismatch. So what happened to mortgage funds in the 2000s? If we all want our money at the same time, they get frozen. And this expands into mortgages, into real estate, into consumer finance, all of quite popular asset classes that are providing pretty attractive interest and income yields at the moment. But we have to be wary that these need to be viewed as long-term investments. And if everyone runs to the door, we need to understand what liquidity our investment is going to offer. The next risk, which isn't talked about enough, but has been raised again when the RBA kept rates on hold in the end of 2025, the risk that inflation gets out of control. It seems like it's settling at the moment. Everything's okay, nothing's too bad. There is a bit of a two-speed economy, but interest rates have fallen a little bit, giving flexibility for those with mortgages, but not enough to impact on those with capital and the interest they're receiving. But tariffs haven't gone away, and wars continue to linger in Europe and parts of the Middle East. There's a lack of agreements on oil supply, and what if employment tightens or China throws a geopolitical bomb into the mix at some point? What the ultimate outcome of these is that interest rates could increase. Now, we're not saying this is likely to be the case, but we have to consider the risks, particularly when we're planning for retirement, and we want to be able to protect our capital, but also both grow it and generate a consistent income. If interest rates were to increase, this would hit fixed interest investments like bonds, at least in the short term. It would also hit businesses trying to raise money, and in some cases could create capital losses, particularly in share market portfolios and anything that's linked to interest rates as well. The next one we want to talk about, and we've seen this raise its head towards the end of 2025, is more risk that the China-US trade relationship worsens. We wake up every day and hear President Trump make a new announcement about negotiations with China on a new trade deal. But BHP, Rio Tinto and Fortescue are a huge part of the ASX index, and China is the biggest net buyer of iron ore and a heap of our other commodities. A worsening China in a struggling economy means slower demand, which hits earnings and our market significantly. The economy is growing at 4.8% in China at the moment, which is slower than usual, but still much faster than pretty much every developed country in the world, like Australia and the US. The problem with this and the problem with these trade wars is that BHP is being used as a pawn to negotiate with the US. That is, China's leaning on BHP, putting restrictions in, and BHP is being asked to change its way of doing business in order to fit what the Chinese are trying to do with the US. So China is competing head-to-head on technology and AI, and there is a risk that this could go bad. But we need to understand how much of our portfolio is not just in China, but actually in companies that are benefiting in generating dividends and income and profit from China, particularly resources, which are cyclical and can slow down incredibly quickly overnight. What other sectors are driven by Chinese demand in Australia? Resources, tourism, consumer demand, technology. These are all things we need to think about and understand where the exposures and risks are within our portfolio. The next one I want to talk about, and this isn't a call either way, is there's a risk, and this is a positive risk, that active outperforms passive in the years to come. So passive or index investing has been incredibly popular. And why not? It's performed exceptionally well in the last 5 to 10 years. Buoyed by the largest companies in the world and their constant growth, you couldn't go wrong. That with such high concentration, as we mentioned in the first point of this video, not much has to go wrong for your portfolios to be hit or for indices to flatline. Think about Japan from the 1970s onwards, or the ASX after the GFC. It took close to a decade, and in some cases several decades, to recover the same point that it was before. And yes, different companies will do well during those periods. With such a reliance on the index for many investors, a lot of people I talk to, a lot of self-funded retirees, invest only into ETFs and only into index funds. One big risk is that the next leg of growth doesn't come from the same companies that it came from in the past. And you may need a larger exposure to those than you currently have. Maybe it comes from China. Maybe it comes from smaller companies. Maybe it comes from the non-technology facing sectors. In this case, your index fund may be too slow moving to capture the full benefit, or you might need some level of active management to get more diversified or get more exposure to companies that aren't on the radar of a lot of other people. The same could be said on the downside. If Nvidia sinks, then portfolios will be significantly impacted. But if we are more actively managed, our holdings could be much lower, and your managers are able to act more quickly and adjust their portfolio as the outlook and as circumstances change. Now, the last point I want to talk about is a risk that everything returns to normal. Gold has become the investment du jour in the last few months and performed exceptionally well in 2025. Having held this investment for 10 years, we understand its merits, but it's also hitting record high after record high in both hedged, currency hedged, and unhedged terms. More investors are buying in today, and gold is benefiting from a huge range of factors, including geopolitical risk, valuation concerns on share markets, uncertainty in policy and trade, increasing populism around the world, and negative sentiment. But what if everything calms down? If if, Middle East conflict to slow down? What if the Ukraine-Russia conflict slows down? What if the trade deals are agreed? What if interest rates continue to fall? And what if the economy just keeps ticking along and inflation doesn't surprise? President Trump could finalize all the deals, all the negotiations, and may see end of his term coming. Could gold bullion reverse course and hurt those investors who got in late, or those investors sitting on significant gains? I think it's a positive thing to think about. Things could turn out better than we expect, which means certain parts of our portfolio may not do exceptionally well. And the key here, the most important thing, is position sizing. If you're holding gold, if you're holding crypto, if you're holding infrastructure, any of these asset classes, get your position sizing correct. Now, one thing I think investors should be looking at, and which self-funded retirees in particular should be looking at this point in time, is infrastructure, particularly and alongside that, private infrastructure, but also private markets. And yes, we've mentioned the risk of liquidity, and noting these are very much 5 to 10 year investments. Just 3% of companies around the world of a reasonable size are available on listed markets. More and more value is created in unlisted markets than ever before. Think SpaceX, Elon Musk's space exploration business, and OpenAI. These are both worth US $500 billion, and they've never seen a share market. They may never see a share market. And infrastructure, similarly, is what I call the picks and shovels of the AI boom. Infrastructure, in this case, could be owning the data centers all these assets are being built on, also owning the energy production or energy transmission that is being used to power those things. It's another way that you can play these themes while taking less equity risk and getting a more consistent income and diversifying your growth at the same time. And the key here is making sure you have greater diversification of sectors and themes, always forcing yourself to have a long-term approach, because in retirement, it can last as long as 30 years from the beginning of your retirement to the end, if not longer. So once again, I hope this video helps you navigate what is an increasingly challenging market. If you're looking for investment advice, investment support, or just looking to plan for your retirement, please reach out. And as always, subscribe to our page, please comment, please like, and please send through any ideas you might have.